Oh, my Lord. Happy Sunday. Good morning. Big O Money Show, Premier Advisory Group here. Tony Shore is with me. Bill Altman is who I am. And we're going to have a great old time today. Because I'm a little, I don't know, a little perturbed, little perturbed here about some things. And I'll talk a little bit about it. So here I'm listening on the torch. We're on KFAB. There's a certain advertiser and he's in the same industry as me.
Okay.
He advertises a lot, big time he is, I think. Talking though about the annuity world.
Oh.
And he's bashing it.
Oh, okay.
And if anybody knows me, they know that annuities certainly are not our main focus. No, nor are they the biggest part of our business by any stretch.
No.
They're actually a smaller piece.
Yeah.
But they really come in great use, and they are protectors of income and protectors of lifestyle,
Sure.
Protectors of assets. Really, they can work well. Non-qualified annuities can grow, and they can still stretch out to the next beneficiaries.
So this guy's saying you don't need any guaranteed income in retirement. You don't like Social Security, a pension, or an annuity. You don't need insurance. I mean, come on.
So
come on.
No, so he talks about other things, and you could do it through. He's now mentioning structured notes. I think he's taken one from our playbook, our buffered indexes. That's okay, though. You can steal.
Buffered index portfolio is great.
They're fantastic. And you can have designed income portfolios, which are with the structured notes. Sure. However, they're not guaranteed, okay, and they're not backed up by some administration that says, hey, if the company goes broke, we're gonna fix it. We're gonna pay it out. Right. Or up to $1 amount, kind of like FDIC, but not FDIC.
Sure. So this person's investment only. They're going to invest everything.
I don't know if they are or not, or they're just kind of trying to tout the I don't know.
They're trying to hook people's interest, like, oh yeah, I've heard annuities.
Yeah. But I will tell you, there hasn't been a default in history on a fixed indexed or a fixed annuity product or a guaranteed life insurance product. Now, if you have a variable that's tied to the stock market, a variable annuity or a variable life insurance policy.
Sure, those are at risk. That's higher risk.
Yeah, but it's variable. You know that. You went into it. It's a mutual fund.
Variable annuities can have high fees, and they are subject to the ups and downs of the market. But fixed index annuities with a guaranteed lifetime income, that guarantee is based on the claims paying ability of the issuing insurance company, which, like you say, that won't default because you work with top rated companies only. And if you work with a trusted financial professional who's working with the top rated companies, then that they haven't defaulted. And in the past, if an insurance company has a problem, they're insured by the state they're in and up to $250,000, and they are also required to have more in reserves for whatever they issue. So over 100%.
You got to have $1 for $1 on reserve for all guaranteed benefits, right?
Yep.
And I think industry standards right around that 105%. So $1.05 for every $100 on reserve.
Sure.
And that's why you don't ever see them in the news. They're not very exciting. However, you can talk to clients of mine. You can talk to very, very smart executive high net worth clients of mine that are in these type of products, and they're paying 8, 9, 10, 11%. There's a 5-year product that's issued by this insurance company. I'm not going to name the name because we don't want guys stealing it from us, but there are multiple of these products that they had cap rates of 11.75% on the S&P 500 with zero risk and zero fee. You have zero downside risk unless the insurance company goes broke and the state doesn't meet their obligation of that 250. It hasn't happened.
But it hasn't happened because in that case they'd get bought out and it would be honored by the bigger insurance company.
Allianz would come in, or North American.
Exactly.
Exactly. Love that for them.
But people do get into, there's pros and cons to every financial vehicle. There's pros and cons to the stock market. There's pros and cons to managed portfolios. There's pros and cons to everything. You just have to know annuities. There are good annuities and there are annuities that don't fit. And I think where they get a bad name is a lot of people have gotten into annuities that weren't right for their situation or at the right time or the right
sold
type.
for the wrong reasons. And
whoever sold them did it because it was a higher commission for them. They weren't looking out for the client's best interests.
Yeah, and whether you're buying a car or a radio or an annuity or a stock or a bond or whatever it may be, there's all of you can do that with any product you ever buy. I mean, you probably buy bad toothpaste. I don't know. You know what I mean? A bad banana. You can do it, but I want to make sure that people understand that. Yeah, you're exactly right, Tony. There's goods and bads and pros and cons. But this last week here, I'm listening to the radio. Poor Danielle, I'm in the car and I'm just getting hot. I'm like, fire up the AC on this. And it's like, why is this guy only telling one side of the story?
Yeah, no, you have to tell the pros and the cons, and you have to say, I mean, he's just totally ignoring like all the baby boomers that utilize fixed index annuities and for hybrids to help with long-term care, to help with guaranteed lifetime income. I mean, there's so many things, and those guarantees again are based on the claims paying ability of the issuing insurance company, which isn't a bad thing. That's a good thing because they have to have 100% of your money at any given time to be able to pay it back. That's the law. So the dollar for dollar of every one they issue to everybody, they have to have dollar for dollar on hand.
Right. And they're audited on the regular too.
Yes. They're regulated.
When I was at American Investors in Topeka, Kansas from 2000 through 2003, I guess I did 4 years of internships there, 4 summers, I should say, of internships there. And I remember auditors, I guess I don't know if they had their own key or key card, but it certainly seemed like they did. They certainly had like their own wing at the building. This particular company American Investors, Ameris Group got bought by Aviva and then Athene. We're talking about substantial companies here. Auditors would be in on a regular basis looking through things, and it was like no big deal, right? Mm-hmm. And they kind of sit down at their cubicle. They go through whatever files that they want to go through because their job, again, is to make sure the state doesn't want to pay anything out. Right. Right. And they don't want they certainly don't want any bad press or media saying, hey, you didn't audit this properly. Right. This company went broke. They should have never went broke. They didn't have the reserves or whatever. Find me a headline that shows it. And you said like the best rated, or you didn't say the best rated companies, but you say good rated company. Good rated companies are important, but I'm gonna tell you, a guy who he's not with us anymore, but great man. He was an executive. His name was Charlie. He was an executive of a very large international insurance company. You know what? He didn't care about ratings. And you know why? Because he knew that whether you're a B-rated company or an A-rated company, you got to keep those same levels of reserves, baby. And sometimes those A-rated companies, it was because they would talk about like they have a more diversified product portfolio, so they have a higher rating. My guess is there a stroke that was a check that was stroked to somebody at some point. Maybe not. Right. But could have happened. I'm just saying, you got 4 companies that have the highest ratings in the industry, only 4. But then you look at their reserve ratios and it's less than the company that's the B rating. I don't know. Call me crazy. Yeah. I think that's a song. Is that like
Call Me Crazy?
Miley Cyrus or something? No, I have no idea.
No, but you should do one. I mean, with a little help from AI, I think you could be a star. Yeah.
A little help from AI.
just a little bit of help from AI.
But, I think what we want to make sure is people realize is like these provide, we talk about guaranteed income, and yeah, you can do a structured note to provide income. It's not guaranteed income, right? But we can do something to provide that. And then you have a buffer or a barrier. If the market drops below a certain point, you no longer have that guaranteed income. If you can structure in something where we've talked about on the show last week or the week before or whatever with like a Social Security. I don't think Social Security is going to go away. I don't even think they're really going to drop it, because I think it would put a lot of people in the poorhouse and the government would have to step in anyway. Right. And so, but let's just say they did. Okay. Let's take that argument and say they drop it by 22% or whatever the number is. And now you have a guaranteed bucket that's going to replace that. If you never have to use that bucket, awesome. Sounds great. Right. And I take free withdrawals, and people think like, oh, I have an annuity and it's gone forever. I can't ever touch it. I locked it away and it goes poof, poof in the sky. Right. No, not true either. So a lot of fallacies out there amongst them. They could be good for a portion of a portfolio, a piece, a bucket of somebody's portfolio. Certainly not for everybody. There is no way that every one of our clients has annuities within their portfolio. There are some that absolutely don't need that piece. They don't need, because there's other things that are protecting, or whatever the situation.
Sure. It's very situational, and everybody's situation is different. Don't let somebody try to say, the problem is if you go to a so-called financial advisor or financial planner, and they say, you need an annuity, they're insurance only. Well, they're just, my dad always said, when all you have is a hammer, everything looks like a nail. Mm-hmm. Like that's their solution for, you need income in retirement, annuity. Right. No, you have to have a balance of things. You can't just have an annuity or just have everything in the market. Most people will probably need some kind of mixture of different types of assets, right?
Yeah. And I had a couple in this week, and great clients of ours, been long-term clients. Husband had some health issues a couple years back, and they have a life insurance policy. They have annuity, life insurance policy, and they have a money in the market. Life insurance policy pays out a massive benefit for long-term care and home health care use. And if they ever use it, the death benefit, if they do not use it, the death benefit goes to the beneficiaries. Very simple. Or whatever is left, the death benefit goes to the beneficiaries. So that's one piece. They have their annuity, and the annuity pays guaranteed income that pays not only for their income needs, but also enough to pay the life insurance policy premiums. And they're looking at this annuity, and they're like, it kept up with our last distribution. The annuity didn't drop any value, and we still have our guaranteed income. Ooh, pretty cool, huh? And so we see that. I mean, how often? Who doesn't like? We've talked about on the show before. Who doesn't like guaranteed income? And I'm definitely a market guy, Tony. I mean, there's no doubt about it. I like the market. I love our G50. I love our Core Select portfolios.
Yeah, you got to have that growth. I mean, most people are going to spend 20 to 35 years in retirement. 30 years now isn't out of the question. Yep. And so you still need long-term growth, right?
Well, you still need long-term growth, yeah, but we can't forget about everything else. And so when people get on and they start just bashing, we had a billboard up one time by this one joker, and the billboard was bashing them. Ken Fisher, I think, was at one point the largest or one of the largest shareholders in an annuity company. Yeah. And his main thing was to bash annuities. You know what? Yeah. He's full of it.
Yeah.
So
a lot of these places that advertise and say, come to us, we'll tell you why annuities are bad. And then you come in and they say, we're going to tell you the negative annuities. They sell annuities.
Oh, yeah.
That's what's funny.
So you want to fire me up. And one of these guys wants to get on the show with me.
Yeah.
One of my competitors wants to sit here in the studio and get on the show, and we can hash it out or whatever.
Sure. Yeah. Typically, these people own. Yeah.
An MMA boxing ring will set up, Tony.
Yeah. Oh, an MMA. Yeah. Yeah.
I mean,
Prize. You could get up on the ropes and just.
I'm going to get Jonathan Sanders in here, and I'm going to tap him in.
Tap Sanders in. He'll take care of him. Yeah, we know a guy. Sanders out in Colorado. He's crazy.
Maybe even B-Lou. I don't know. Maybe
he's a wrestler. Sure, B-Lou. He's a big guy. He'll take care of it.
Yeah.
Well, hey, yeah, and I think, people say, I think the things people hear about annuities are high fees, lack of liquidity. I can't access my money. And we can address that because nowadays it's so competitive. The beauty is it's gotten so competitive because so few people have pensions. That's why annuities have gotten popular, and to compete with banks, to compete with the stock market, these insurance companies have offered better and better offerings, and annuities really aren't, it's not your dad's annuity or your grandfather's annuity. These are little to no fees on fixed index annuities, and a lot of them. And you can take, most of them you can take 5 or 10% out a year with no penalty, with early withdrawal penalties. So, and you
go 5 years. So like you're talking, Tony, I mean, we're talking about a 5-year, you can say 10% out per year without any penalty.
Sure.
You have let's just say it's an 8% upside potential on the S&P 500. So if the S&P does 12, you get 8. If it does 4, you get 4, right? If it does negative 12, you get 0. And you have no fees on that same one. And you're in for 5 years. It's a good piece for a portion of the portfolio, or you structure it. And that's like more of like the bond replacement, right?
Right.
It's like, how can we get some good interest? The bond market was great last year. Bond market kind of stinks this year, right? Because we're used, it's always you're used to what we just saw, right? And last year we had interest rates that came down. And so we had our same bond performance at like that, say 4% on a 10-year treasury roughly. Let's just say that. But then you also had interest rates that were coming down. So it was forcing the value of your current bond holdings up. It's an inverse relationship. Well, this year we still have that 4% coupon rate on that bond, but we have really very little interest rate movement and a little kind of tick up in interest rates. And people are like, oh my gosh, I'm losing money in the bond market. Well, not really. But that's what it kind of looks like, or that's what it feels like.
Sure.
That's a piece. There's nothing wrong with fixed income percentages within your portfolio. There's nothing wrong with that, having an allocation there.
Right. Annuities are a way to create a personal pension if you don't have a pension.
A personal pension, or a supplement of, or if my husband or wife dies and their Social Security drops off, I flip on the trigger and the income stays. Or if or if that whole Social Security comes to fruition, and all of a sudden Social Security is broke, again, it's been broke forever, it seems like, but it's broke again, right?
Yeah.
And then Social Security is going to drop and you flip on the trigger, and if it never happens, you don't need to flip on the trigger. At least you have that security. The same thing, the same reason we have car insurance or life insurance. I really don't want to use it. I'm not really too interested in using my life insurance policy, to be honest with you, Tony.
Well, right. Yeah.
Or my car insurance policy,
Well, I hope I get to use that life insurance policy. Oh, wait. That would mean I would have to. Oh,
maybe my wife thinks differently, but
sure. Yeah. I mean, we talked to Danielle and she's got a different story. We'll have to have her on to talk about
that baby on.
Yeah.
No, I'm kidding. I think she likes me still. Yeah. But we think about all these different things. So why do we have the health insurance policy? Yeah, it's fantastic to have. And hopefully I really never have to use it, like really use it. Right. Or, and the car, we don't want our kids to get in a car accident. Oh, we certainly have car insurance, right? Do you have car insurance just because it's state mandated? I don't. I have car insurance to make sure that if something happens, then I don't have to deal with it and it doesn't bankrupt.
Why wouldn't you want to take out insurance on your retirement or insurance on your, I mean, I don't know. It's I mean, we have home insurance and car insurance, and people need that income insurance or insurance on retirement. I think it makes sense for a lot of folks, and you do have to look at the timing of it. How what's your time horizon? When do you need the money you'll be putting in? How long does it need to last? These types of things dictate where that money should go. And you look at it openly. You're not going in with a bias like, okay, I'm going to find a way to get X amount of dollars into an annuity for this person. No,
No.
but no, when do you need the money? Where does it need to go? You guys want to be, that's why you're like family with your client. Your clients are like family. And
Well, here are your options.
Yeah.
Or I'm paying too much. How about somebody that does not like paying taxes? Okay. I think it's a lot of people, but let's just say you got somebody that's really, the anti-tax, like I want to pay at least amount as possible. They got a bunch of money. And let's just say there's a bunch of non-qualified money, non-IRA money. And they're like, hey, because if I pay taxes and, then it boosts me up into a new bracket for my Medicare, that whole IRMA thing and everything else kind of gets messed up,
Sure.
blah, blah, blah. What if we took a portion of those non-qualified assets, the non-IRA money, the money that you've pretty much already paid taxes unless you have long-term capital gains within there, right?
Sure.
But it's not the IRA stuff. It's not the pre-tax stuff. So we move that over into a non-qualified annuity or a portion of that. I mean, we did this with a couple $1 million of a client's money not too long ago because he and his wife did not like paying taxes on all this money. They're conservative. They don't spend a lot of money. And they want it to go to their kids, but their kids are young. They still have a long life expectancy in front of themselves. So, not including the kids, they have a long life expectancy.
Sure.
And so we reposition a couple $1 million over to this annuity that has like an 8% cap, or maybe it's like 9.75% cap. I forget exactly. They have no market risk. It eliminated their fees because it was actually a no load. It was a no fee. They can still take free withdrawals, which they don't because they have plenty of other money.
Sure.
But now all their earnings are tax deferred. So now I got $2 million. Let's call it 8%. So I got 160 grand a year, right? That is coming in to their account, to their estate, and they're not paying taxes because it's tax deferred. And so you say, oh yeah, well, you got to pay taxes on it someday. Yes, you do, but they're not going to touch it.
Just the earnings.
Their kids, and the kids are going to do a stretch non-qualified, and they're going to stretch this non-qualified money out over their lifetimes because that's still the law. That's still how that can work.
Yeah.
Right.
You can still stretch that, unlike an IRA, which you can no longer stretch like that.
Right. And, let's just say worst comes and they go into a nursing home and they need crazy care and it's 20 years from now. Well, right now, Tony, you and I both know nursing homes are what, 10, 12, 14, 15,000 bucks a year. Right. Well, what are they going to be in 20 or 30 years? I would say probably more. I don't think it's going down. Right. It's like, is the government going to spend less or get real? Right. It's like that question, right?
Yeah, that's crazy. But Bill, I think to put it together, one of the best things you said is you have to look at all the options, and you guys look at every option and figure out, as a fiduciary, you're held to the fiduciary standard, which means you have to make choices or help your clients make choices that are in their best interest, not yours, not somebody else's, theirs. And I don't know how a wealth advisor or a financial company can say annuities are bad and then just move them off the table. If you're a fiduciary, you have to look at you have to look at everything?
That owns one of the largest investment firms that puts billboards up and ads out and about how bad he hates them, but then he also owns largest shareholder in one of the biggest annuity companies. I mean,
right?
come on.
Yeah,
I mean,
and even the ads you hear on the radio that you're talking about, that person probably owns an insurance only business that's separate with a separate name. And then if he has an opportunity, he will sell them that company. He just takes off one hat, puts on the other, right?
Yeah.
Because they make you separate out those companies. So what they're doing is, I think, deceiving. And if they really are taking it off the table, like some companies say they do, then they're not acting as a fiduciary, because I want somebody who's not, you don't ever want to touch any other means but this. Then it's the hammer and nail problem. You're not looking at all the options,
Yeah, don't ever buy a car because they're all bad. You should only take the bus.
Yeah, that's not fiduciary advice.
No.
That's not looking out for your personal best interest. A bus may be the best option in your situation for certain things, but are we just only looking at one option, or are we going to look at everything and say what fits this need or your goals financially?
And if somebody says they just don't like them, because they heard what Susie Orman said or something like that. Yeah, fine. Sounds good, cool. No,
even she said she was talking about variable annuities. So
I know, right? Yeah, that's the whole thing. Is it's back to the car analogy. Like, you don't like the Pinto because they blow up. Got it. But that old Toyota works out pretty
so
well.
You're not going to ever drive a car because you heard Pintos blow up. That's the analogy. Yeah. Well, hey, we got to go. We're out of time.
Gosh. Okay.
Great. Bill, we got excited today. You got on your soapbox. I love it. How can our listeners and viewers get a hold of you?
Yeah, give me a call, 402-557-6730. Again, 402-557-6730. Book your complimentary consultation with one of us. We'd love to see you. And you can always go to bigomoney.com.
All right. Thanks. And that does it for today's episode of The Big O Money Show with Bill Altman.